If the public equity market is a racetrack, then a company's stock is merely the car's glossy exterior. Great investors, however, are more interested in what lies under the hood. They want to understand how the business actually makes money, what its engine is, what powers it, how it ages, and what might break it down. This is not just about reading financial statements or tracking earnings per share. It's about grasping the logic of the business model. What is the basic unit of analysis that drives profits? What strategic moat, if any, protects those profits from erosion? These questions sit at the intersection of valuation and strategy, and they are non-negotiable for great investors. In this video, the third in a 10-part series, we explore why an unshakable grasp of how a company makes money is the foundation of sound investment. From store economics to EUV lithography, we'll walk through examples that show how fundamental understanding builds conviction, filters noise, and creates superior returns. Every great investor starts with a deceptively simple question. What's the real engine of this business? To answer it, one must strip away consolidated P&Ls and high-level growth narratives to reveal the business's atomic unit. In retail, it's the individual store. In SaaS, it's the individual subscriber. In biotech, it's the drug pipeline productivity. Each sector has a different unit that drives value creation. Consider Costco. The core engine of Costco's business is not about maximizing margins on goods sold, but about maximizing membership revenue per household. Its stores are built for scale, but the economic profitability hinges more on customer loyalty and renewal rates than individual SKUs. It earns less on products, but makes up for it with recurring fee income and rapid inventory turns. Contrast this with Amazon Go, the cashierless convenience store concept. The narrative was rich, high-tech, seamless, futuristic, but the unit economics couldn't match the capital intensity and low ticket size of each store. Despite technological prowess, the basic engine sputtered under scrutiny. Great investors distill a business to this core unit, building a mental model from the ground up, not from Wall Street's top-down narratives. Once the economic engine is understood, the next question is, how defensible is it? This brings us to sustainable competitive advantage, or what Warren Buffett calls the moat. The test of a moat is whether a company earns returns on invested capital consistently above its cost of capital. Not once, not in one boom year, but over cycles. ASML is a textbook case. It owns the global monopoly in extreme ultraviolet lithography, the technology critical to making the most advanced semiconductors. Its moat is built on decades of R&D, high switching costs, and a patent fortress. It operates in a hyper-competitive industry, but remains uniquely irreplaceable in the chip value chain. Its ROIC soars above 30% in some years, reflecting its strategic choke point role. Contrast this with companies that operate with operational excellence, but without strategic differentiation. Without barriers to entry, today's gains become tomorrow's margin erosion. Porter's 5 forces may seem dated to some, but its principles endure. Supplier power, buyer power, threat of new entrants, threat of substitutes, and industry rivalry. Each force erodes value. Moats repel them. Strategy is not about doing more, it's about choosing what not to do. Michael Porter's key insight is that operational effectiveness, being leaner, faster, cheaper, is not strategy. True strategy lies in trade-offs. Great investors look for businesses that are deliberately different, not just incrementally better. Take Ferrari, for example. The company could easily double its volumes to meet surging demand, but it doesn't. Why? Because scarcity is the moat. By capping production, Ferrari maintains pricing power, brand exclusivity, and astronomical margins. Its EBIT margins exceed 25%, more in line with luxury goods than auto manufacturers. This kind of clarity, trading scale for status, is the hallmark of strategic thinking. And it often defies Wall Street's obsession with growth at all costs. A common mistake among investors is to treat strategy and valuation as separate silos. In truth, they're inseparable. The durability of a company's cash flows and the ability to forecast them hinges on the strength of its business model and moat. Any DCF model that doesn't rigorously question the sustainability of competitive advantage is mere math cosplay. Look at Peloton. At its peak, investors extrapolated pandemic-era demand, assuming a hardware-driven flywheel. But Peloton's moat was illusory, hardware was commoditized, and the subscription layer lacked stickiness. Once gyms reopened and competitors like Apple and Nike entered digital fitness, the strategy faltered. Valuations collapsed accordingly. To forecast free cash flows intelligently, one must understand the strategic assumptions embedded in the model. Great investors don't just look for what to own, they know what to avoid. The principle is Buffett's circle of competence. If you don't understand how a business makes money, don't invest. Full stop. Consider WeWork, a case where investors bought into a narrative of disruption and culture rather than evaluating lease arbitrage unit economics. The core business model, leasing long and renting short, was fundamentally flawed. High fixed costs, cyclical demand, and no moat. It took a near total collapse for the market to wake up. Understanding how a business makes money isn't just about seizing opportunities. It's also about avoiding landmines. Understanding a business model isn't a mystical art. It's a skill, and skills can be learned. Here are a few key tools. Porter's 5 forces for industry-level context. Value chain analysis for margin mapping and control points. Moat mapping for defensibility across cost, brand, network, and IP. Reverse DCFs to test the plausibility of strategic assumptions. Unit economic models to isolate the profitability of the smallest revenue-generating entity. And crucially, talk to users. Read product reviews. Understand customer pain points. Business models start with customers, not cap tables. The benefits of this approach don't just add up, they compound over time. With a deep understanding of how a business makes money, forecasting becomes more precise because you know exactly what drives revenues and costs beneath the surface. You become sharper at spotting inflection points, as you're able to recognize early signs that a company's moat is weakening or under threat. And perhaps most importantly, your sell discipline improves. You're no longer reliant on market sentiment or short-term noise. You can clearly see when a company's strategic trajectory no longer supports its valuation and act accordingly. Of course, not all investors dig deep into strategy. Quant funds and momentum traders profit without touching a 10K. Some VCs back charismatic founders pre-product. But great investors, those seeking compounding machines, prefer clarity over opacity. While momentum fades and narratives shift, understanding endures. In the end, understanding how a company makes money is the skeleton key to great investing. It unlocks conviction, filters noise, and connects strategy to valuation in a way spreadsheets alone never can. So the next time you look at a company, don't start with earnings. Start with the engine. Because great investors don't just buy stocks, they buy businesses.